Hey everybody, welcome back to the channel. Today I've got an awesome program for you today. Today I have got Josh Spurrell, CPA, in-house today, and he's going to be talking to us all about calculating your proper profit margin, how to bid your jobs, how to price your work, and because I get these questions all of the time from my clients, my coaching clients, and they always ask me, how do I calculate my margin? How do I make sure I'm making enough money? Do I calculate, what do I include in my gross profit? What do I include in my job costing? So they ask me all these questions, and now I finally have a CPA who helps small businesses all the time, one of the top in Canada. Thank you, Josh, so much for joining us today.
Right on, Trevor. I'm excited to talk about this topic because it is it's one of the challenges all the time because it's like the unique unicorn syndrome. Everyone thinks you don't know my business. It's like, yes. Actually, I do. I know every tax return ever filed in Canada by industry code and what the averages are on pricing. It's like, I really do. I actually know it better than you know it. and so that might sound like harsh to people because they've been in that industry forever, but we really do know, like we know what the gross profit margins are by industry based on the quartiles of the business. So I'm excited to talk about it.
All right. Okay. So let's get started. I guess from the top, pricing. Okay. How should contractors be working on their pricing and setting their appropriate margins?
I mean, okay, so there's life cycles of a business. Okay, if you could plan it ideally, the first step is like step number 1, you work for free. Step number 2, you're underpaid. Step number 3, you can work for market rates. And step 4, you can charge whatever you want if you're good enough.
Right.
And so you have to understand where you are in the life cycle of a business. And I would suggest you can. I mean, you can't work for free for very long. So that's going to be a challenge, right? Unless you got a side job or something. So you can't work for free for very long. You can generally be underpaid in most industries up to about $1 million of revenue. Once you cross about $1 million of revenue, it gets harder and harder. You have to run faster and faster on that wheel where you'll wake up and you're actually getting further behind if your margin's not right. If it's too low, like you have margin, but it's too low, you'll be further behind at 2 million than you were at $1 million in sales. You can't sell your way out of that bad margin. So a lot of what a lot of what you do before $1 million is somewhat based on, kind of reading the tea leaves on that day.
Okay.
But ultimately, after $1 million, it's like you know exactly where you're trying to get to. So even before $1 million, you actually know where you're trying to get to. It's just you might not have the credibility to be there on that day, if that makes sense.
Yeah, I got you. So let's say you're a contractor, you've been going for a couple of years and really pricing out these jobs so that you're making a decent amount of profit. So for example, I have some of my customers who are trying to calculate how much overhead they have and how much they should, calculate the percentage wise of their overhead into their profit margin so they can price a job. Like they go through all of this complicated, transactions and trying to figure out this math. What should they be doing?
Yeah, so it's a common mistake where people try to put that overhead into their pricing, but your overhead changes all the time. I mean, just as a percentage, if you do $50,000 worth of work 1 month and $150,000 worth of work the next month, obviously, are you going to change your pricing based on you're not the airline industry. You're not Air Canada pricing it by an algorithm. That's not how it's going to work. Plus, overhead expenses, they move up in nature in kind of steps. They don't go up incrementally like direct costs. It's like you either rent a new space or you hire a new administrator, but they don't grow evenly like your direct costs. So trying to set your pricing based on your overhead is kind of a fool's game. We'll calculate your break even, but you're not going to change your pricing just because you had a new or updated overhead expenditure. Like because you'd be updating your pricing every single day for the rest of your life, which is not, it's not fruitful. So you're going to plan off of your direct costs. And so as a contractor, you're going to plan generally off of your direct labor and the materials that you spend on that job. Okay. That's how you want to base your pricing, not off the overhead. So that it's really just direct labor, materials on the job. What is the cost of that? Does that make sense?
That makes sense. So when you're talking about the direct costs, so you're basically parts and labor, right? Parts and labor. How do we calculate the labor part? Because I've got some clients who are, trying to do some kind of algorithm where they've got, their journeyman price is this much and their apprentice price is this much, and they're trying to combine this so that they come up with a number at the end where they make profit. How should they be doing that so that it makes sense in the long term?
Okay, so general rules of thumb, we're going to need to operate at about a 40% margin. It can be slightly different in different industries. And again, people will say, I don't know your industry. It's like, no, I know it. I can look it up. I can look every industry up. Yeah. And we look it up by quartiles too. Okay, so there's, we can see it by the bottom 25%. We can see it by the lower middle 25%, the upper middle 25%, and the top 25%. But we also know that 96% of the businesses go bankrupt. So if you're not in the top quartile, the long-term trajectory for that business is bankruptcy. Okay. That's as harsh as I can make it for people, but like I have to make this harsh because this is like one of the reasons why, people fail. Customers cash flow team, and if like they don't have their pricing right, it'll never work. So most industries, like most service contractors, it's going to be around, like, we're going to price at a 40% margin. And if we get 35, we're happy. It can be slightly different in some industries. It's like, if I'm doing full scale residential construction, I'm probably not going to get 35%. If I get 31%, I'm okay. But I'm also building things that cost 500, 800, 1.5 million. I'm building whole houses, right? I'm not coming out to change someone's furnace at a 20% margin. Like that's not going to work long term. Okay, so in order to people have to understand the difference between margin and markup.
Yes.
It's like the quintessential difference. Like if I want a 40% margin, if I'm trying to price at a 40% margin, so I have some room for error. It's like I have some misestimation, I have some warranty work, and I know I need to get 35 points, so I'm going to try to get 40. Okay, what I have to do is, people will think, okay, I need 40%. I'm just going to times my cost by 1.4. But if you have $100 and you times it by 1.4 and you charge 140 and it costs you 100, you have 40 out of 140. That's a 29% margin, not a 40% margin. If you want a 40% margin, something that costs you $100, you have to charge $167. Now you have 67 of 167. That's a 40% margin. So difference between margin and markup. If you want a 40% margin, you have to mark up by 1.67. And this is the number where I just repeat time and time again, meeting and meeting, because it's just like it's a loop, and I have to break people out of the loop, right? And if I want a 40% margin, that's what it's, and that's going to be 80% of service businesses are going to be in that. If I'm, like I said, if I'm building whole houses, or if I'm selling used cars, it's like, I'm not going to get a 40% margin. Okay. Right. But if I'm coming out to change furnaces, or I'm doing flooring, or I'm doing drywalling, or I'm a painter, or I'm a mason, if I'm doing masonry work, if I'm doing roofing, it's like, it's eerily similar across the service industries, right? With a couple of exceptions, but again, your exceptions aren't really exceptions because we can look them up. We know what they are. They're not that secretive. Okay.
Yeah, the ones who get especially good margins are concrete guys.
Yep. Concrete guys. Like a dentist, for example, we get wildly more than 40% margin. Because like they're more 60% margin, but the equipment in that office is way more expensive. Those X-ray machines, setting up that office, it's like, so we need to be at a 60% margin because the equipment the overhead is going to be a lot in that sort of practice, right?
Let's jump back to how to price your labor. Like, how do you price your guys out in the field?
So generally speaking, you have two components of the labor. Okay, so you have what you actually pay them, their gross wages, and you have your burden, okay? Let's say general rule of thumb is if you pay someone $50 an hour you are going to have to mark that up by 1.2 to get to your true cost, because you got to pay CPP, the employer CPP, employer EI, you might have WCB, you're going to have maybe a benefit plan. Okay, so that guy who's $50 an hour probably costs you $60 an hour. So first of all, you have to figure out what your costs are. General rule of thumb is going to be around 1.2. So you got to mark that up by 1.2, whatever you pay. Okay, now it's that cost that you need to mark up to get your profit margin. Okay. So then if it's that, we'll work with that one where it's $45 an hour.
Sure.
Right? That $45 an hour. So the $45 an hour guy, he costs us $54 an hour. Okay. And if I'm doing quoted projects, different than doing service work, if you're trying to quote too perfectly, like this is going to take 3 hours. First of all, if it's less than 8 hours, it should have been a service call at a different rate. Okay. But if I'm trying to say it's 12 hours or 14 hours, like, no, it's 1 man day, 2 man days, 3 man days, 4 man days. And you just think the number of guys. Okay. So I got $54 an hour. And let's just say this is a project for 2 guys for 2 days. Okay. So at 54, and I'll figure out the man day. So at 54, I'm at $432. That's my cost to have a guy on site for a day. Okay. Now, we talked about before, like the apprentices and journeymen.
Right.
Okay. Yeah. This is the myth where people are like, well, I'm going to have this apprentice there on that day. It's like, you don't know. You're booking this project a month and a half out. Johnny, who you just hired as a first year, might decide that he doesn't want to be a plumber anymore in 3 weeks. You don't know who's going to be on that. And some projects are going to be very conducive for having apprentices on, where they'll do the exact same amount of work in the exact same amount of time as a journeyman. And sometimes the journeyman is sitting around teaching the apprentice how to do the work, and it's taking him longer to teach the apprentice than if the journeyman was doing it himself. So the general rule of thumb is you always price off your journeyman rate. Okay. So always price off your journeyman rate. And that's how you're going to get your pricing, because you don't know if it's going to be 2 journeymen out there. It's going to be 1 journeyman and an apprentice. It's going to be 1 journeyman who's just going to be there for 4 days instead of 2 guys for 2 days. Right.
Right.
You're not quite sure at that point when you're putting it on the calendar. So that's how you're going to bid it. And so it's going to be $432 that's going to cost you. And this is a 4-day project, 4-man day project. So it's either 1 guy for 4 days or it's 2 guys for 2 days, right?
Right.
And like I said, don't get too finite into if you think it's going to be 13 hours. Like, first of all, I was like, I don't believe you, because no one prices that good, right?
Yeah.
It's like you're talking in terms of man days. And, even if you knew exactly, what do you have planned for that guy for the rest of the day? Okay. Are you going to be able to fill his calendar? Is that sort of variable? Like, how is that going to affect your staffing as you move forward? Okay. If you keep cutting their hours short. Okay.
Right.
It's a much harder staffing assignment. And so the 432, I know my labor cost is $17.28. Okay. So let's just go on the 432 first, which is my cost. I have to times it by 1.67. So that's 720. I'm going to round up $722.
Okay.
I need to charge that guy out at $722 per day. Okay. So if it's 4 man days, that's $2,886. That's the price I need to charge the customer. Okay. Plus any like materials or parts, like I also need to mark those up by 1.672. That is the margin of a scalable business. And that shocks people.
Yeah, it does, because
it shocks people when they see the numbers.
I get customers who I tell this to, and they're like, there's no way that anyone's going to hire me at that price.
That's right. Because like how a business operates, like fundamentally most service business, how they operate is you're going to sell something to a customer for $100. It's going to cost you $65. You're going to try to get $60. You're going to try for it to cost $60 to make $40. But over time, you're going to have some things go wrong. Someone stiff you on payments, some warranty work. It's like you're going to get $35. Your overhead is going to cost you $20, and you're going to have $15 left over. $15. That means if you discount your price by 10%, oh, no problem, I'll take 10% off. That's 2/3 of your profit. 2/3 of your profit. That'll be in a scalable business, right? And you start to think about that. It's like, and then you go back to that overhead part of it. It's like you also know that you actually just can't really service the overhead until, in most businesses, it's about $1 million in revenue. And the only way you overcome that is just as a business owner, bootstrapping is usually you're doing a bunch of the overhead work yourself. You're doing a bunch of the office work. You're doing, maybe you don't have a cleaner in the office. Maybe you do it on it's basically you working for free to overcome that. But at the end of the day, we only get the 168 hours in the week. Won't be able to do that at 2 million, at 3 million. It won't work. You got to have the right pricing in place. And everyone you're competing with has to have the right pricing in place too, because they don't have infinite capacity. That's the big thing, is like they think there's this guy on Kijiji and he's going to do it for cheaper. It's like, but he's one dude. He won't even answer his phone 9 times out of 10 because he's too busy, even if he is working hard, to even come close to doing that amount of work, right? And so that we really we got to get a 40% margin, and it's gonna shock people. It's going to feel too expensive, but it's ultimately that is your limiting belief. Right. Like that is the limiting belief, because we know what the successful companies actually charge at. Right.
Okay. So let's say I'm a contractor and I've been, bidding my jobs in a certain way. Let's say I've been trying to, calculate what my overhead is and trying to piece that into there. And I've been charging only 45 for a journeyman and 25 for the apprentice. And, I get calls and, people say that my pricing is at the top end of any quotes that they've gotten. What kind of advice, like where do I go from there? Let's say that I feel like I am the top, like one of the top prices. What are the next steps? How do I graduate from there to charging, my 40% margin on my labor?
So first
expenses.
If you start closing more than 50% of the opportunities, it means your prices are too low. Everyone thinks like, I close at 80%. It's like, you didn't close at 80%. You just bought the work because you didn't charge enough. Like if you're closing more than 50% of the deals, your prices are too low. That's the market telling you. That's not telling you you're amazing or you're great. It's your prices are too low. You just bought the work. You're not getting to $10 million with those prices. And so ultimately we know what we have to raise to, and then it goes to that. What's that life cycle? Am I at $100,000 in revenue a year, or am I at $1 million? If I'm at $1 million, my goal is to stop servicing the clients that won't pay me my fair margin. Right. Where it gets tricky is if all of my $1 million in revenue is at clients who don't pay me the right margin. I'm working for a bunch of other contractors, and the reason why I got 2 million. So now you have to slowly wean yourself off of those. And people will think, I'm going to keep them. It's like, no, your goal is to get rid of them entirely, or at least get to the point where you can give them a take it or leave it offer. Okay.
Right.
So now your goal is like, I don't want any more work at $1 million at the wrong margin. I only want work at the right margin. I might continue to service existing customers, but my goal is to get to a position where I can give them a take it or leave it offer.
Right. So you have to have good reputation. You have to have the manpower. You have to have a proven track record. What are some other things that you need in order to be able to give them a take it or leave it offer?
You just need to have demand from other sources. So if you're just working for, crappy cookie cutter home builders, it's like that's probably the hardest. Like new home construction is the hardest. Yeah. It's the reason why these new home builders go out of business all the time, because they themselves are operating at a too low of a margin, right? Where guys doing tenant improvements in nice commercial spaces or custom homes, they have kind of a higher probability of success because they're not trying to build 1,000 homes this year at some ridiculously small profit margin, right? They're actually saying, I'm going to make a fair profit margin, charge this, and like I only need to build a couple homes and I need to do it right. Okay, they're much more tuned to value, right? And when you're starting out, the lowest level value that you can provide, where you become it's just convenience. Okay, so even though you're more expensive than the cheap guy in Kijiji, the cheap guy in Kijiji can't get there all the time because he can't afford to hire people.
Right.
And so eventually his phone is going to go to voicemail one day, and you call up someone who they don't really care that your flooring is more expensive. They've been waiting for 2 weeks for the guy on Kijiji. That's where, and then you can get there today and do it right. And then they realize that that's a scalable solution on their side too. So, you know, really at a low level, it's just quicker. And we've all done this. We've all paid, you know, $5 for the bottle of water at, you know, the exhibition or the hockey game or something like this. We all know we can get the bottle of water for cheaper at Costco. But we're all going to pay for that convenience at some point, right? And slowly over time, you want it to go from I'm just the guy who can do it, you know, give people convenience to I do something better than someone else. I can do the more complex projects that other people don't understand. It's like I'm not the plumber who can come out and fix you know, a clogged drain. It's like I know how to install the $20,000 reverse osmosis water system. And the guy who I installed the water system for, when he needs service work, he wants me to do it. He doesn't want another company to do it. He doesn't really care that you're more expensive. Because the main fear when you buy something is not that you paid too much. The main fear is that the thing that you bought doesn't do the thing that you wanted it to do.
Yeah, that is the big concern.
That is that is the ultimate concern, right? And then you want to get into the more premium buyers where they actually are discerning in that thing that they buy, because there's always people who there's always things in our lives that we don't care about and we have the cheapest option. And then there's always things that we do care about where we're willing to pay more to get the thing that we want because we're interested in it, right? If you are the cheap brand, it's like the only people who reach out to you are the ones who think you're the cheapest option. You can see the psychology. It's like the number one of the easiest indicators is whenever you see that Facebook request. It's like, I'm looking for a plumber in my area. They knew darn well they could just went on Google and found a good reputable plumber. What they really meant to say is, I'm looking for a plumber who's really small, doesn't know what he's worth, and I can rip him off as a customer and not pay him enough.
Bingo, Facebook Marketplace.
It is like, it's like it took a long time to, and I see them sometimes too. I'm looking for an accountant. So one of my clients nicely says, I recommend these guys. Like, and you know, before you go on and say, oh yeah, no problem, call the office. I'm not calling at all. I'm not posting anything on there. It's like you knew my number when you did this. I showed up first on Google when you did the search to begin with, right?
Yeah.
It's like, you know, but then there's a discerning buyer who's like, they did a bunch of research and they wanted someone who was really, you know, either could be there right away or is really good at what they do, right? But that's hard. What I'm saying sounds easy, but it's hard. What it means is that 4-year journeyman program that you took was useless.
Yes.
What it means, it's all the learning that you do every year for the rest of your life that determines your value. You always know how to do the more complex projects and the updated and modern projects because you never, ever stop learning and never stop putting the time in to learn it.
Yeah, that's really good. I love that. So I've got some questions from actual clients of mine, and they are all related to this topic because they're always trying to figure out, like, how much should I be charging, making, how do I make it make sense for paying my guys? So let's start with this first one here. How do I calculate my current gross margin and net profit margin accurately with removing owner discretionary earnings?
Okay, so you need a good double entry QuickBooks, a good double entry accounting software. Okay, so if I'm talking to business owners on margin and they're telling me what their margin is, I don't believe them. I need to see a reconciled double entry accounting system. And I should have at the top of it, I have my revenue, I have my labor, I have my materials, and I have my gross margin. Okay, I'm going to generally look at that then. After we've reviewed it, we generally, I like to review compared to monthly balance sheet, compared to monthly income statements. And the reason why that is because I'm looking for anomalies. So I know things are actually coded correctly, that the records are reliable. And then when I calculate the margin, when I have that margin, I'm looking at the trailing 12 months. The trailing 12 months. The myth is like, I calculated my margin last month and it was amazing. I was like, well, that's because you had 2 pay periods last month and a biweekly, in a biweekly cycle every 6 months you're going to get 3 pay periods once every 6 months. And I tell them, like, the amount of timing errors is significant. You know, that bill from the supplier comes in the next month and all of a sudden you didn't look like you didn't make any money. Keep in mind, public companies with big, sophisticated accounting system and teams of people, they only release their numbers every 3 months.
Right.
They only release quarterly reports. Monthly reports are like, I look at monthly reports, but I'm looking for mistakes. I'm not analyzing the profit on a monthly basis because there's too many timing errors. I'm generally, in most businesses, looking at the trailing 12 months. I'm going to look at the trailing 12 months because usually in most businesses, you need at least 6 months to tease out the timing errors, if not a year. In a lot of businesses with any sort of seasonality, you need trailing 12 months. You know, go back to the plumber and electrician. It's like, or just go to the plumber. You know, the repairs for furnaces, if you have a broken furnace, you're a different type of customer than the furnace who wants a fancy new air conditioner. Because the broken furnace was a want. I had to call you. I didn't really want to call you, but this thing broke. The air conditioner is like, you didn't need an air conditioner. No one needs an air conditioner in Canada. It's not the UAE, you know, it's not going to be 50 degrees. Like, you'll be uncomfortable, but you'll survive, right? and so it becomes a want. Like, that person is generally willing to pay a little bit more to get the right size air conditioner, the one that they want. And so in most businesses, you have to look at the trailing 12 months to really know what the profit margin is. And it comes from that process review.
The last part of the question was, how do you calculate these things with removing owner discretionary earnings?
So then below that, then you would have in that built into that double entry accounting software, like a QuickBooks, it's like now you'd have your overhead. Okay. The owner's salary, the owner and their family members should not appear anywhere in those accounts. They should not appear in the direct account. They should not appear in the overhead. You should have an other item that actually identifies. So it's either going through the shareholder loan or it's an other income statement item showing how much the owners got paid. And then when we do a profit analysis, generally we're going to have a column every month when we're benchmarking. We're going to look at what the QuickBooks file actually told us, and then we're going to make adjustments. And the adjustments are going to be for the fair value of what we paid the owner, because maybe the owner is worth $100,000 a year and we paid them nothing. Or maybe the owner is worth $100,000 a year and we pay them $200,000. Right. And so what we pay the owner is not based on what they're worth. What we pay the owner is what, you know, is best for tax or what's the best for financing.
Right.
Which is often different. So the first step is like, it never should have been commingled with those accounts to begin with. It should have been a standalone account. And then when we're doing the benchmarking, we add back in the fair value for the owner's work on the tools, so to speak. Okay. How many hours that they're working or how many days a week that they're on the tools.
But you're not doing this on a monthly basis.
For our outsourced clients, every single month we benchmark them.
Okay.
And so like you know, if you get someone who's, you know, telling you they don't know that calculation at 200,000, it'd be like, okay, that makes sense. We can calculate it once per year. But at $1 million, someone of a level of sophistication should be doing that for you every single month, right?
Right.
They should be doing, and they should be setting up the accounts in that way so that can be done. So yeah, every single month in our outsourced accounting meetings, we look at comparative monthly balance sheet, comparative monthly income statement, year to date profit and loss versus last year. And that's not generally a margin analysis. That just tells me how much I'm selling versus this period last year. It's generally a revenue analysis. But then to determine margin and benchmarking, I'm going to look at the trailing 12 months. So instead of that small business that's 200,000 that I do this once a year, I'm going to do it every single month. And I don't look at that month. I look at the trailing 12 months. Okay. And then I'm going to take that from the data file where I've separated out the, I've separated out the owner remuneration. And I'm going to add back in a fair value owner remuneration, and then I'm going to compare them to the benchmark, and the benchmark being the top 25% in their industry. And I know what I'm trying to hit.
Nice.
And so some people would say, it's like, can you show me how to do that? I was like, yeah, as soon as you show me, write me an instruction manual on how to change out the electrical panel, then I can show you how to do that reliably every single month. So the devil's in the details. It's like, could you learn? You could, but you're probably better off to, can come work for us for a year full time, and then you'll have somewhat of a understanding on how to actually categorize stuff the right way, and then you'll be able to do it. So anyone over $1 million in revenue, if they don't have someone of sophistication doing that for them every month, the person doing that for them doesn't know what they're doing.
Hard lessons to learn, right? And so many people, they hire an accountant, not necessarily a CPA. And, just from what I've seen out there, I've noticed that it doesn't seem like accountants are at the same level or at the same bar. I take for granted that, we've been business partners for the last 7 years, and I take for granted all of our meetings and stuff that we have, but maybe just for people out there, like, what is the difference between an accountant and a CPA?
I mean, it's not the designation that matters.
No.
It's just not the designation. It's like what we do is we call it fractional CFO work. Mm-hmm. It's like, and nothing that I do is actually even restricted. It's like, CPAs have a restricted service. It's like a doctor, when they prescribe you medicine, that's a restricted service. Mm-hmm. Okay? In the accounting world, it's like the restricted services are reviews and are audits. And 99% of the private businesses that you're dealing with don't need either. They don't need a review and they don't need an audit to get the finance that they want. What they do need to know is how to calculate their margin. That's what they actually need to know, right?
Which is what we're talking about today.
That's right. And then I'm going to overlay that, because the clients that we work on together, it's like I take the reporting sheets that we've built together, right? And then we look at their monthly reporting, and then we're lining it up with other KPIs. It's like, okay, you had less sales, but how many Google reviews did you get leading up into there? What was your ad spend month by month leading up for there, right? Mm-hmm. And because we look at, reports in, financial reports in columns, right? And so we've organized our other KPIs in columns so we can actually line them up with the months, where it's like, because people are like, I doubled my revenue. It's like, no kidding. You doubled your ad spend 3 months ago. Like, that's what happened. It's like there's a gasoline container, turned over, and you're wondering, like, I don't know how this fire got here. It's like, I can tell you how the fire got there. It's like you have 1 million impressions on you have 400,000 ad impressions in the last 6 months. Like, that's how we got here.
That's right? How that happened.
That's how it got here, right? And so we can actually look at those numbers, those KPIs, and it's a level of experience. It's like, I went to school, I got an accounting degree, but what I'm telling you to do wasn't taught to me at school.
No.
It wasn't taught to me at school. It's like, I passed the test, so I was smart enough to pass the test, but there's really nothing on that test that's relevant to what I'm going to do in that monthly meeting. And who are the people that I do this with? It's like, we could sell more packages. I'm going to go back to the reverse osmosis thing. It's like, if you're a plumber and you hire another plumber, do you expect that they know how to install a reverse osmosis system tomorrow? Probably not. If you go hire another electrician, just hire any journeyman electrician, how many Tesla Powerwalls have they installed?
Right.
You know what I mean? Like, they don't know how to do it, right? It indicates that they might have the capability to learn if they pass the test, but they don't know how to do it. And so even the meetings that I'm not involved in, who's running those meetings? People are running those meetings who've spent thousands of hours in those same meetings with me, who know how to do that benchmarking and that analysis, right? And so if you're like I would love to tell you that there's a lot of people out there who know how to do it, but the numbers indicate otherwise, because that's why 96% of the businesses fail, because they more than 4% of them have accountants, but they don't know what they actually should be looking at.
Right. And the accountants aren't curious enough to really learn what it's going to take for the business to stay in business, so they come back next year, right? Mm-hmm. They're just hoping they come back so they can file their tax return and not go out of business.
Yes.
So leads me to my next question here from one of my clients. How do I calculate my gross profit margin required to achieve my desired net profit? Number one, what is your desired net profit?
So your gross profit margin, like, we're going to know what our desired profit margin is. And in order to calculate, once we know what our desired profit margin is, to get to your desired net margin, you need to calculate the amount of revenue you'll need to get that, because it's like, okay, I'm going to get 35 to 40 points for every sale. I know what my overhead is. Your overhead's going to be relatively consistent. Okay. It's not like you book another project and you need another person answering the phones tomorrow, or you need to move out of the space and pay your landlord more rent because you sold more. It's like, that's generally not how it works. Okay. So in order to get your desired net profit margin, once we know our desired gross margin and our overhead expenses based on the trailing 12 months, because a lot of your overhead expenses, you might have annual dues or insurances that only come up once a year, right? Once you calculate that, now to calculate if there's a desired net margin that you want, you basically calculate your sales number that you'll need in order to get that, because you know what your gross profit margin, your desired gross profit margin is going to be.
Okay, so it really comes down to a function of how much am I selling, and am I selling it at the right margin?
That's right.
All right.
Yeah, that's right.
Next question. When calculating for quotas and bonuses, what would be an appropriate commission-based sales structure?
I would do for commissions and bonuses, I like to do on revenue, because you start doing on any sort of profit margin, it gets difficult. And you could get a deal from a supplier or run some sort of campaign, and you're gonna be at a conflict. But you have to make sure that the person who's getting the commission also does not have any freedom to set the prices.
Right.
So if they're getting a commission, they can't change the pricing to get their commission. It's just like the bartender who pours too much drinks to get more tips. They don't care that it costs more in alcohol. Right. So like generally you want to offer your commissions based on gross revenue, and it needs to be simple too. And even when it goes down to it, a lot of times I don't like gross revenue per person. I don't like individual metrics. I like team metrics. Because if I have a valuable journeyman, his main value is not installing this thing. His main value is teaching the apprentices to be good. And I like the person who does the project good gets paid like this. The person who's great who gets paid like this. And the person who can teach other people who are good to be great gets paid like this. Right. It's like, I want a guy, because ultimately it's like, okay, so you double your sales, but I need $100,000 to hit my break even, and we sell $80,000. I got to pay you a commission. Meanwhile, I had, all these problems on all these other job sites, and I got no one financially motivated to help me. And so you have to be that's where a discussion with a CFO will help you actually discern that, right? Where a lot of times team metrics for your key people are better than individual metrics for your key people, because the key people generally, in order for you to succeed, are going to have some level of supervisory responsibility.
Okay. So what in the scenario of, in this particular client has people who were in the field and now they've moved into the office and they're doing basically, strictly sales. So selling, electrical jobs, selling plumbing jobs, and they get a commission based off of what they sell. Basically, eat what you kill.
Yeah.
How do you set that scenario up?
That's easy. Gross sales for the company. Gross sales for the company, that's easy. And that person making the sales does not have the freedom to pick and choose a price they want to buy their commission, basically. Okay. They have to sell it at the price that you set. Right?
So you do like a base plus kind of thing? Or
usually it's 0% until you hit X. So like if, because I know my overhead, I know my break-even point. Well, I don't want to pay any commission if I'm below my break-even point.
Right.
I'm not giving you 1% of something when I'm losing money this month. Right. And so usually it's once you hit X, your commission kicks in.
Gotcha.
And then it becomes a percentage, and usually bigger numbers based on team performance. That one's an easy one, right? Because
nice. So basically, whatever, as long as the company has met their break-even point, above that, then you get a graduated commission structure based off of that.
Correct.
Gotcha.
Yep.
Cool.
Yep.
Now, how can you guarantee a commission-based sales structure to be profitable while at the same time taking care of your employee with respect to their income?
So ultimately, you can't afford to pay a commission if you're not profitable.
Yeah.
So the commission can't kick in until you're profitable. And this might sound harsh, but the company's profitability is senior to the employee's financial circumstances. Because if the company is not profitable, no one has a job, including that employee.
That's right.
So, like that needs to be senior. I would say once you have that figured out, now you could actually set it because you have a realistic desired profit margin. So you know when you're giving a salesperson a percentage of commission, you know what that's going to affect on the overhead. Okay. So you kind of can reliably project it. But if you're every month you're trying to reset your pricing based on how much you spent in insurance or the one new person who's answering the phones, it's like it's not going to work.
Right.
You won't be able to set a realistic commission. Right.
So then do you have like a base plus? So basically you calculate the base into the overhead and whatnot.
Yeah.
Or the break-even point, I guess.
Yes.
And then you have some kind of graduated commission scale on top of that.
Yes. And ultimately, most labor laws in provinces are going to force a base plus, even if that base is minimum wage.
Right.
So the base is implicitly forced upon us through labor law. So whether you wanted it to or not, I believe every province in Canada would default to minimum wage as the base.
Okay.
Even if they were so-called straight commission.
Sure. Yeah. Essentially, it has to come to that because, slave labor isn't allowed yet.
That's right. And really, if they're not hitting their commission, it's like getting rid of them is a favor for you and them because they're you were probably not hitting your profitability metrics either. Right?
Leads me to the next question, actually. So in trades like plumbing, electrical, what is the valid amount that a salesperson should be able to bring in?
So most people will overestimate the importance of sales and underestimate the importance of sales process.
Okay.
Selling most service calls should be done by an administrator at $20 to $25 an hour. Like,
right.
That's what it should be. It's like there's a script. They should have a written list of things that if the customer calls in for this leaky faucet, this, and this is a service call, Mr. and Mrs. Smith. This sounds like something we can take care of in less than a day. This is our hourly rate. We come out to assess it. If we find that it's going to take more than one day, we will have someone give you a firm quote before we proceed. And it's just a script, and it's just someone putting it on a calendar. Where the people need a greater level of sophistication is the stuff that generally takes more than a day. It's more than a service call. It's more than an hourly charge. And the service call, by the way, usually has to be more than a 40% gross margin because everybody underestimates the importance of task switching. That $45 an hour, person, if we look at it on an hourly rate, so if we have $45 and our burden is 20%, then that's 54, and we times it out by 1.67, we're effectively charging about $90 an hour.
Right.
But those are multiple day projects. That same service call guy needs to go to $135 an hour. Just take the 45 multiplied by 3. That's the service call rate because they just won't be busy all the time on service. There'd be a significant amount of downtime on smaller projects.
And that also would solve the problem of, we didn't anticipate we need this part. I have to run to the supplier, right? Because that happens, right? A lot of time is wasted going to and from the suppliers, waiting in line, traffic, and so forth. So the job doesn't get done quickly. And then they want to make sure that they're billing accordingly. Now, how do you square that circle with a customer and say, okay,
script? We have well-stocked vans. We have most of the parts there, but in the event that we need to go and source a part, that time is billable.
There you go.
And if you don't get at least 50% of the people hang up, and it means you were too cheap. It means your prices were your process was too flexible for them. It's like, hey, I'm going to run to the store and stand there for an hour looking for this special attachment that only deals with your parts, and I'm going to do it for 2 hours for free just because I wasn't in your house. Like that was, that's billable time. Right?
So really, it's a mind shift that these owners have to get into. They have to figure out, okay, it's just a script. It's nothing personal, but you're not doing it for free. You're not going shopping to the plumbing supplier for free for somebody just because you don't have that particular widget on your vehicle. Right?
That's right.
Yeah.
That's right.
Now, the next question that I've got from my customer is, with healthy numbers, what is the ratio of employee count to overall sales revenue?
Oh, that can be like very different in different industries. Even it can be very different in the same industries depending on how much, like if you're doing very heavy material installs, So the electrician who's installing Tesla walls will have way less employees than the guy who's, just doing rewiring projects.
Right.
Because it's a heavier labor, right? So there's not going to be one magical, fit all solution, right? And I would say that calculation is secondary to actually just knowing your gross profit margin.
Right.
It could be an interesting metric, and we use it sometimes to project. It's like here's how we use that calculation. It's like long-term planning. It's like, I want to get from 2 million to 4 million. Okay, well, how many guys do I have right now doing the 2 million at the right profit margin? That means in order for me to get to 4 million, I'll need this many guys in 2 or 3 years. How am I going to bring that many guys through it? But, am I going to change my prices based on some? No. I'm going to use that for long-term planning. And usually I use that for HR planning. How many people? Okay, because that becomes a math game too. It's like, if I need that many people, how many group interviews am I going to do? How much am I going to spend on ads to do that, to get that many people come to that group interview, to source this many people? What's my churn going to be? How many deadbeats do I have to go through to get the good guys that I want to keep on the team anyways, right?
Yeah.
And so that becomes a number game. That would be primarily how I use that metric. So I wouldn't pick a metric based on industry, because it could be different and it could be changed over time. I hit my desired profit margin first, and then I look at the head count I needed to do that revenue level. Because as a business owner, I don't really care that much if I was making money off of selling the parts or if I was selling the labor. I just care that I was making the margin.
Right.
At the end of the day.
Yeah. So once you understand and you're making the margin and things are running well, and basically you can, it's predictable, more predictable, then it's just a matter of multiplication.
That's right.
Yeah.
Yeah. That's exactly how I would use that metric.
Okay. So let's talk about overhead. So when calculating true overhead costs, would it be safe to take your income and simply subtract cost of goods, payroll, other income, and add back in the office salaried payroll?
No, that's a crazy calculation. So that's someone inventing accounting processes. Start with revenue first, deduct your parts, deduct your direct labor, have your gross margin, and then calculate your itemized overhead categories. And they don't have to be too precise, because most of your overhead generally lives in the administrative labor, whether that's the sales or administrative staff, and it lives in the space that you occupy. And the other category that's really important to us is the ads.
Right.
Actually, what am I spending on creating and distributing content? That's and because even though that tends to be a smaller number, we know if it declines too far, our risk is different. And most of the other overhead, we look at it to see if they're strange, but I would say most of it is kind of white noise in the equation. It's important to look at every month so I don't have something crazy that's happening in there.
So you can see anomalies.
So I can see anomalies, right? There's some $1,400 a month Yellow Pages, subscription that we have that doesn't bring in any revenue, or, an insurance that's like wildly, disproportional to what we're doing, and we look for a new provider, right? But yeah, so like, I'm not going to go for I'm not going to start calculating my overhead to get to my margin. It's just a misunderstanding of the calculation to begin with, right? And fundamentally, the harsh part is like, you're being asked from a business owner who's actually trying to calculate this themselves.
Yes. And
it would be like me. It's like, Trevor, imagine if I told you that, Trevor, I just tried to change out the panel in my house, and I was just wondering, the sheen of the concrete on the floor, it looks like the wrong. Should I put this epoxy coating on this floor? Will this make it easier for me to stand up while I'm changing the panel?
Yeah, ridiculous.
Yeah, it's like it's like they need to start from the top. You wouldn't start from your overhead to get your gross margin. You start from your revenue, sales, gross margin, and most everything lives in there. Like most of the businesses, what are my sales? What's my cost of materials? What's my cost of my labor? What's the cost of the space that I occupy? What's the cost of the administrative staff? What do I spend on ads? And what's the white noise?
Right.
And that, like that, you would be
And people get stuck in the white noise.
stuck in that white noise. They get stuck in the white noise, right? Too much so, right? Where it's like, because basically most of the white noise should be worth none of your time as a business owner. At most, it's like, I think I'm paying too much for phones. Great. Well, that means I'm going to assign someone a couple of days to go look at phone plans to switch the company over. So am I saving $10 a month a phone? How long will it take me to break even on assigning that out? Because I'm certainly not doing it as a business owner.
Right.
Right. And then I have to realize that everyone's going to have some downtime while we're loading up their new phones and that sort of thing. It's like, I get reached out all the time by people trying to sell us new tax filing software. Ooh. And they're like, oh, we can beat the price by 10%. It's like you'd have to pay me tens of thousands of dollars to train the rest of the staff on new software.
Yeah. What do you have? About 23, 24 people you'd have to train on?
Yeah.
New software.
It's not the right metric, right? Like the break even would be years on that. Right, on the one new feature that they have, right?
Wow. Yeah, no, that's really good. And I think people need to hear that. They need to understand that, there's a lot of stuff that is just nonsense and in the minutia. Look at it, but that's not how you're determining your pricing. It's not how you're determining your profit. It's not how you're determining these things, these decisions going forward. It's just noise. So I got one more question from a client here. It says, with this true overhead cost number, would it be safe to simply divide that by 251 working days and then divide that by how many crews you have on the road that day and add to those jobs? It sounds like another experiment.
It's an experiment because what are you dividing it to? Like some months you'll do 50 and some months 50 in revenue and some months you'll do 150 in revenue, right? That's not how you're going to do. You don't set your pricing based on your overhead. You basically have to make your overhead work depending on the pricing because we know what the market can bear. We know what the market can bear in terms of what sort of desired margin we can make, right? And so once we know this is the revenue that we can obtain, it's like that tells us what our budget of overhead is. We have to make that overhead work, right? We don't tell the customer of what the industry pricing is. We know what the industry pricing is. And a lot of times it's way higher than everyone thinks that it is, right? But we don't change it just because your landlord wanted more. If your landlord wanted more, maybe we need a new space to rent because we can't afford that space, or maybe we have to sublet a portion of that space. We can't change the industry standard for pricing based on the latest new overhead expenditure that month.
Right.
The pricing does not get set from the bottom up based on the overhead expenses. The pricing gets set from the middle based on the cost of sales, and that tells us what the pricing needs to be. And then once we have that gross margin, we have to only take on overhead expenditures that we can afford, and then we have to calculate out a reasonable growth rate, right? So sometimes it's like we can take on this extra administrative staff because we think we can get from 1.2 million to 1.5 million in a reasonable amount of time. Right. In which case that starts to make sense, right? But I don't just hire a new administrator and then change all my pricing.
No.
Like I'm not going to do that. That's not how it works because the cost of the materials and the cost of the man hours required to do that job didn't change. And the constraints didn't change. So it is a common misconception on how to look at it as someone is just like driving themselves nuts on the numbers. Okay.
Right.
And that is the job of a CFO is to tell you the numbers that matter and the ones that don't.
Yeah.
Right. And and the ones that matter would be that where it's like, less than $1 million. Most accountants should be calculating your margin for you every single year. They don't have to. Like CRA doesn't care whether you have it as direct cost or supplies, because ultimately they just charge you tax on the net income. Like they're never going to say, hey, here's your penalty because you put it in overhead supplies and you did put it in direct costs. Like maybe you're more likely to get audited. It might look strange to them, but ultimately it doesn't change the tax rate, right? But our annuals, like we calculate what the margin is. It's right on the financial statements. Here's your gross margin versus last year. And even on an annual level, I would never put the owner's pay in there. I would always itemize out the owner's pay at the bottom. Okay. And so if the owner's doing none of the work on the tools, that's a pretty fair margin. If the owner is doing some work on the tools, I have to impute that number because what I actually paid them was irrelevant. I paid them based on what was the best for financing or the best for tax.
Right.
And so I have to impute a fair value for their work on the tools, not their overhead sales work to get to a margin. And so be really careful. It's like taking from the bottom up, you're actually overcomplicating it. And also be careful on industry per part rates. It's like this is a linear foot or this is a square foot.
Right.
Those are decent secondary tests, but they're not a primary test. And you have to understand, it's like we just went through a 5-year period where the monetary system, where the money supply increased dramatically, where prices for everything increased dramatically, and prices were changing at suppliers daily.
Yes,
daily. So it was like all of my clients, basically, they have these numbers in their heads per square foot, per unit, per linear foot. And all of a sudden it was like their pricing was so outdated. It's like they all went into a coma for 10 years and woke up and didn't know the industry pricing. It's like usually they're trailing by a year or two, but they were all trailing by like a decade because everything changed so rapidly, so quickly. So
they weren't calculating their invoicing based on margin. They're doing it based on old ways of doing it.
An old per unit number where it's like the primary test. Because ultimately it's like it doesn't matter if someone you used to work for used to charge this much per square foot.
Right.
What matters is how much is your labor going to be on this project? How much of your materials going to be on that project? Is there a chance I can get my 40% margin, or a couple things can go wrong and I can still get my 35?
Right.
That's all that matters. Some arbitrary per square foot math, it's like, it doesn't work. Like in order to run a scalable business, it's like you're going to need about 20% in overhead usually. So, so it's, I need to sell something for 100. I need to make at least 35. I'm going to have $20 left over for overhead. That's enough overhead to help me scale. Okay. When I'm only selling $100,000, that $20,000 in overhead is not going to go very far. I can't hire someone full time to answer the phones yet, right?
No,
you're not going to find someone full time for $20,000 an hour, and all your other overhead expenses go to zero, right? You're doing that.
Yeah, you'd have a hard time even just existing at that level.
That's right. You're doing that, and so and then I get to my 15%, and it's like, and clients fight all the time. It's like, well, I got this big project that's going to give me, I have $1 million in sale, but I got this one big project. It's going to be $500,000 in sale, but I'm only going to have a 15% margin. It's like, you might as well just stay home.
Yeah. Why would you?
You might as well just stay home, right? Think about it. It's like if you raise your prices 10% and 10% of your customers leave, you just increased your profitability. Because you replace the revenue with the existing customers who paid 10% more, but you have now 10% less work to do and stuff to buy to do the work.
Right.
You're taking home more money in that scenario. It's not what we bring in revenue. It's what we keep that matters. Right.
Right. Okay. Well, that was awesome. Thank you so much for being with us and taking the time out of your busy schedule to be on our podcast. Guys, this was actual gold today. So anybody has any questions about margins, profit margin, how to price your jobs, how to price your people, this was the podcast for it. So check it out. Share it with somebody who can use this information. And of course, if you need a CPA in Canada, look at spurrell.ca, spurrell.ca. And, we are Inspired Method. We're business coaches and marketing guys here. And we'd love to help you with your project and help you grow your business because we want to make businesses stay in business for the long term. See you on the next one.